If you've ever worried about long-term care or how you're going to pay for it, the costs of long-term care insurance and how they're increasing, then this video is going to be for you. I recorded my conversation with Ben Green from Greenberg, Wexler, and Eig, and they're an independent agency right here outside of Washington, D.C. They are hyper-specialized, and I was really impressed with Ben and what he shared with me in conversations that we had previously to this. So I wanted to give you guys an opportunity to listen into the conversation that he and I had about long-term care and how he views it as an expert in the field. And Ben does a really nice job of talking through all kinds of things about long-term care in this conversation. So I know you're going to love it. So Ben, thanks so much for joining today. I can't tell you how many questions we've gotten from federal employees about just all of the different components with long-term care and how they should be thinking about some of these things. And so one of the common misconceptions that we often get is, what is the difference between health insurance versus long-term care? A lot of people think, hey, Medicare does have some kind of long-term care component. Can you talk a little bit about what is truly long-term care insurance?
Sure. And thank you, Tiago, for having me today. It's a pleasure to be here and really just kind of give information about this type of insurance plan. So basically, long-term care insurance is different from health insurance in the sense that health insurance is a policy that's going to protect you really in the day-to-day. If you get sick and you needed to go to the doctor or go to the hospital in some situations, they're going to provide some level of funding or compensation for that visit. Long-term care is very different from this type of insurance. First off, long-term care is not a necessity. It's not required to be had by anybody. And really what this type of coverage is providing is in the situation where you are unable to do normal functions of daily living. And this can be consisting of being able to feed yourself, being able to go to the bathroom, being able to dress yourself. These types of functions, if you are unable to do at least two of them, long-term care coverage would be able to click in and provide you with a monthly benefit that's tax-free that you're able to use for your care. This can be in an in-home situation where someone is coming to your house to take care of you in this kind of format, or it's also covering you if you needed to move into an assisted living home.
Yeah, and that's huge because the Health and Human Services talks about how 70% of people over age 65 are going to need some type of help later on in life before they die. And so there's a lot that can go wrong in situations, and having that little bit of support can also be very expensive. At least we've found with clients, if they need to hire help, and depending on whether or not that help is in home care, or if they have to go to, a worst case scenario would be like an assisted living facility, the cost can get really substantial. And a retirement plan sometimes can it's almost like it's a torpedo to a retirement plan if they haven't planned those things out or they don't have the assets to cover it themselves.
Right. It's also the thing you want to be thinking about is that right now in society, we're living longer. That's not something that people can shy away from. And
Yeah.
unfortunately, as we get older, our bodies start to take a major impact and we lose those abilities that we take for granted as we're young or as we get older. And whether or not you have long-term care, whether or not you have the funds, something is going to occur where you're going to need assistance in some kind of way. And whether that's having long-term care coverage in place or having the ability to self-insure, the funds are going to be needed somehow, some way, in one way or another. And when you're looking at the differences of in-home as opposed to assisted living care, right now, after the last 3 years and dealing with a pandemic, the need for care is getting greater and greater. And the need for that the desire is to actually to have that in an in-home care scenario because people feel more comfortable in that kind of situation. And the problem is that it costs. There is no denying that the cost of things are getting higher. We're seeing it in a high inflation market now, and that won't change. And as time goes on, this type of care is going to be very expensive, and that responsibility is going to fall on whether you have insurance or not.
Yeah, and in fact, everybody who's listening who has a long-term care insurance policy from John Hancock, the federal long-term care insurance program, you've probably gotten your letter already that says, hey, this is the premium increase. Now, we know it hasn't happened in a little bit, and they are doing that 3-year phase increase. But I have clients who have gone maybe it's 20 or 30% over these 3 years. And I have other clients who are experiencing almost 80% in an increase to their premium over these 3 years. And it sounds like they can expect these costs to continue to go up because that's the nature and the status of the long-term care business.
Yes. And really, it's not dependent on what age you are. We're seeing, I think that with your clients that you're seeing whether they're 50 years old or 65 years old, 70 years old, these increases are occurring to everybody. And like you said, we're seeing an average of around 20% every year increase on those premiums. And this may not go away. So there's a lot of undetermined area that we're looking at in the future when it comes to these types of policies. The problem is with the federal program is, right now you have the federal long-term care program is sponsored by John Hancock. And if you were to look anywhere else outside of that program, you would notice that John Hancock doesn't even sell long-term care policies to individuals that are looking in the independent market. That alone is telling because one, it's showing that carriers are actually getting out of the long-term care business. And one thing we want to make sure that we're understanding when it comes to long-term care is that there are different types of long-term care out there. So when we're talking about the federal program, this type of long-term care is what's known as traditional long-term care. When the long-term care market started, this was the really only type of product that was available out there. And what this type of product is basically a long-term care program that when you pay a premium every single year that you're expected to pay, this coverage will be in place. And you are expected to pay that every single year until the coverage is needed. The problem with this is that you could potentially pass away without ever having the need for long-term care.
Right.
So that means that you've been paying into a policy that you potentially will not see the benefit come out of. This is how the federal program policy is structured. And with John Hancock being the one that's providing that or sponsoring that program, the fact that they're no longer selling new policies is very telling that they're actually getting out of the long-term care market. So with that said, we're seeing that this federal program is almost becoming an antique product, unfortunately.
Yeah. And I think we've seen it too, where there are other carriers who have pulled out of this business altogether already. And
Yes.
so OPM is assessing, hey, do we continue to be able to offer this as kind of a benefit to people who are in federal service? And John Hancock is trying to assess, hey, do we continue wanting to offer these policies because at some point it's almost not even profitable to them. They have to keep increasing these rates and people will eventually stop paying for premiums. And we find that the premiums get so expensive when you need them the most and the 75, 80 years old. And then people are having to make really hard decisions about their retirement and thinking, okay, now we're looking at possibly needing to change our lifestyle or make different compromises because we just have to continue to pay for the insurance or take on this risk ourselves, which could be 50, 60, $70,000 a year. Who knows?
Oh,
Right.
that could be a minimum of the cost. Really, it really is something that we look at when we're doing the planning process of long-term care for our clients. One of the most important things that we try to determine when we're doing the quoting stage is how much is a monthly long-term care scenario for a person, depending on where they live, because obviously different geographical locations have different costs and things. This area, for example, in the Maryland, DC, Virginia area, the cost of care is on the higher end. And so when we start the quoting, we use around a roughly $6,000 a month benefit as a starting point. And we're not saying that care may cost $6,000 every month. It's that average. Cost could become even higher than $6,000 a month. So those are things that we want to keep in mind when we're doing the pricing of products. But taking a step back to how traditional long-term care was and what it's becoming to is where you used to have a number of carriers like John Hancock that would provide these types of policies. We're now in a market where there's only one good viable carrier that provides traditional long-term care now, and that is Mutual of Omaha. We tend to use this as a kind of an explanation point just to show how traditional long-term care works. But the reason all these carriers are getting out of it is because, just like you said, you have all these policies where people were keeping premiums low and paying those premiums. The problem is that they don't account for how much care is actually needed to be paid out when these policies go into use. And that's the problem with the carriers now is that they were not priced out properly beforehand. And now with all the care that's had to be issued out, they're needing to increase the premiums for the current policies to make up for all that care that's been distributed. So most carriers in the long-term care space are, the way they define their premiums, are not guaranteed. And what that means is that you, like you said, you could see these price increases as the years go on, and it's really up to the carrier to make that decision on when they're going to increase their payments. Now, where we are with the federal program is that we're seeing increases on an annual basis for the next 3 years. Well, what happens after that 3-year period?
Right.
Could these people be getting a notice in the mail that says, okay, we're going to continually be upgrade or increasing your premiums? And the problem becomes where someone gets to the point where they don't want to be making these payment increases anymore. What's their situation where they could qualify for long-term care at this point? Because now they're older, they've been in this policy, they've been paying this premium, and they're not going to see a return of that. What is their insurability risk? Because the problem is that now that they're older, they may not be able to get approved for long-term care. And now they're in a hole where, okay, I don't want to pay for my policy anymore, but I'm also unable to approve for a new policy. So now that's going to be coming out of my pocket or someone else's that's in my family, someone that's going to be taking care of me.
Yeah. Yeah. And it's such a difficult situation to see because we've seen it with people that have had private policies that are similar to the federal run, where again, it's every 2 or 3 years, they're getting a whopping 25-30% increase. And it has been the case. The federal long-term care one had a period of time where they didn't see the increases, but you're totally right. Depending on how the business is, what is stopping them from not increasing these rates? They're going to be looking, and that's what people have to think about too. When insurance companies price premiums, they are looking at you as an individual, but it's actuaries doing the math, and they're trying to figure out what are the probabilities of their having to pay out an event, how long it's going to cost them, and they're pricing it accordingly. So because we're living longer and inflation is rising the costs of everything around us, including care, that's where it's becoming a challenge.
Absolutely. And it's not only just that, just taking the federal program specifically, one of the major benefits of this type of program is it doesn't require any medical underwriting. So just as information for your viewers, medical underwriting is the carrier's review process of determining what your insurability is. They will do a deep dive in the sense of what your medical history has been, see if there's ever been any major illnesses, surgeries, any prescription medication that you're taking. They will consider all of this before they come out with an approval rating. When it comes to long-term care, they're looking at things where if you've ever had back issues or knee problems, they may look at that and really do consideration when it comes to approving an individual, because this may lead to a long-term care claim in the future. And as much as we want to say insurance is a great tool, it is, but insurance carriers do not want to pay benefits. It's not something that they're inclined to. They're just like any business out there where they're trying to make money. And when they start making payments for claims or paying out benefits, this is hitting their bottom line, essentially. Now, looking at the federal program specifically, the big benefit here is that there was no medical underwriting required for participants of the program and their spouses. So to really put someone in a program where, they have no idea where the likelihood of the benefits being paid out, well, it's good because of younger individuals, they're able to keep up with the premium payments. The problem is as you get older and these benefits starting to be needing to pay out, the carriers are realizing, okay, now it's time for us to start jacking up those premium prices. And really for individuals, they're looking at it as like, well, that may not affect me because I got approved and, I'm healthy and I'm making my premium payments, but it'll catch up as time goes on.
Yeah, and in fact, we talked to some younger feds, so typically mid-career, people that are, in their maybe mid 40s, early 50s. A lot of them will say to us, "You know what, Tiago, we're not really thinking about long-term care yet because we feel like we're too young. We were thinking about waiting until, we're 58, 59, or maybe when we're 60, we'll start thinking about long-term care." But as you know, there's kind of a point in which you really are getting the best bang for your buck, especially when we talk about some of these policies that you've explained to me before that can have a stable premium built in, and understanding what that can do to the ability to forecast those costs, build those into a retirement plan, right? And all the other benefits. Can you talk a little bit about what you've seen in that area?
Sure, absolutely. Going back to your initial point about where that good age frame of looking at long-term care is, insurance overall, as you get older, becomes more expensive. Not that necessarily in the sense that it'll get more expensive as time goes on, but if let's say you're not looking at an insurance product until you're in your 60s or God forbid your 70s, the price of the premium is going to be exceptionally higher because of your age. Now, looking at these programs and really determining where that good sweet spot is to really look at this type of coverage where it's not breaking the bank is what it's kind of similar to what you said. I would say between your late 40s and your early 50s, because there's a number of factors that you want to take a look at when you're looking at the pricing at those age points. One, the prices for these types of products tend to be much more manageable when you're younger. Two, it's locking in a point where you're allowing yourself or you're allowing the product to grow as time goes on, because a lot of these long-term care programs offer an inflation rider, and this can be designed a number of ways. But really what the benefit is doing is that it's allowing your policy to grow as the years go on. So where you initially started with a certain amount of benefit, let's take just as an example, the $6,000 a month. That $6,000 of tax-free benefit at starting at the age of 50, for instance, is on day one, God forbid you did need the long-term care coverage, you're getting that amount. But you're getting this policy for the future because God forbid something were to happen to you when you're older and your body's falling a bit apart. This is where the coverage is most needed. And this inflation protection will actually substantially increase that monthly benefit as the years go on, where you could be looking 20 years down the line at close to 12,000 a month
Right.
for coverage. So really putting those policies in place earlier on is allowing you time, not just taking into consideration of getting lower premiums, but it's also allowing time for the policy to grow and give you substantial more benefit in the future when the time of care is needed.
Yeah, that's a really great point. And one of the things that you and I were talking about recently is you mentioned the form of these different kinds of long-term care policies, and you call them the hybrid plans, where you do get to stabilize these premiums. It is more consistent and you can plan for it better in the context of a retirement plan. Can you explain a little bit about how those work?
Absolutely. So, as I was saying, that traditional long-term care was where the market started for long-term care coverage. Um, Now that carriers are getting out of this type of coverage or this type of product, the long-term care market is heading into something new that's, I would say, more appealing to people when it comes to getting insurance products. Really, when you buy an insurance product, and this can be the same for long-term care, life insurance, really what you want to be doing is you want to be getting a guaranteed product. The reason for this is that all of this type of insurance and insurance in general, it's protection. Now, it's not, you don't want to look at protection as an investment vehicle. You don't want to look at it as a retirement plan. It
Right.
is simply that protection first. So when I think about protection, I'm thinking about making sure that something is there. God forbid the situation for me changes, whether that's death, whether that's becoming unable to take care of myself. And I want to make sure that that product is there no matter what. And it's providing me substantial amount of coverage and there's no surprises to it. So where traditional would be classified as a non-guarantee type of product, and that being because, premiums can increase. You're not guaranteed to get the coverage because you could pass away before ever using
Right.
it. Hybrids or hybrid long-term care is where this market is heading towards. This is due to the guarantees that are attached to it. So when I say guarantees attached to a hybrid long-term care policy, I'm talking about it is the premiums that you're paying into, meaning you will never see an increase on the premium that you're paying. The premiums are designed to be paid in two forms. Either one is a lump sum payment, and the other form is over a 10-year payment structure. Now, with that 10-year payment structure, every year you're paying the same amount of premium, but you're never going to be paying a higher premium in those 10-year period. Now, something I want to make note about the hybrid market is it tends to be a higher costing type of long-term care coverage plan than what's compared to the traditional long-term care. The reason for the higher cost is because of those guarantees.
Right.
I think that when people buy something, they don't want to be surprised by it. So with the locked in cost, you're seeing that, you're able to plan more accordingly for how much that coverage is going to cost and how much you're getting out of it in the long run. Now with these hybrids, the other big factor that's being contributed to, this kind of higher level tiered product is the inflation that comes along with it. So I'm just going to give you some rough numbers that can really be designed differently, but it'll give you an idea of how the performance works. So if you were a 55-year-old that got a policy in place at with the starting benefit amount of $6,000 a month, when care is really needed and we're looking out into the future, typically, the average age of where a long-term care claim comes into play is probably around earliest age is around 82
Like
years
80.
old.
Yeah.
Yeah. So at that point, with the inflation rider attached to this type of policy, you could be seeing your benefit grow to, $12,000 to $15,000 a month because, $6,000 a month is a good amount of benefit. The problem is $6,000 going to be the same value it is today as it is 20 years from now? We're in a high inflation market right now. So we're seeing that the cost of things are going up and up and up. And we don't see right now a period where that may come back down. This inflation protection really provides substantial benefit on these hybrid policies where the future will be requiring more funds and this policy will be able to keep up with that. Another big part of the hybrid product is where with traditional long-term care, you could pass away without ever needing the care. A hybrid policy actually has a life insurance death benefit attached to it, where it is in the amount close to or equal to the amount of premium that you put into the policy. So one way to look at this is that if you were to prematurely pass away before ever needing long-term care benefit, you're actually always going to see a return of principal with the death benefit that's attached to it. This is a huge part for policyholders because when you're looking at a higher premium costing product, people tend to get nervous that they're putting a lot of money into something that really they may never see the value of. And with this death benefit attached to a hybrid policy, you're always going to see the return of money that you put into it, which I think provides some level of comfort to someone that's having to put a lot of money into something.
Yeah, absolutely. That's a huge thing. And I know our clients have been really excited about that feature because if not for the surviving spouse, it goes on to, the additional legacy, whether that becomes part of their estate or the kids or anything like that. And
Exactly.
so they don't feel like it's car insurance or fire insurance where you're just constantly writing these checks and you never seem to get that. I mean, you hope you don't have to use it, of course,
Of
but
course.
you also have the benefit of not having lost those premiums along the way. The only thing being that people, of course, it is the principal amount. It's not like it would have been grown or invested over that time. Because that's the other argument some people make is, well, what if I take a chunk of money, throw it in an account and invest it ourselves? But to your point, you're paying for guarantees. There is no guarantee in the market. Yes, over time, we know markets perform and that they can provide you growth if you're invested correctly. But of course, there's never a guarantee. Whereas with a product like this, it will be there as long as the insurance company is still there to provide that contract.
Absolutely. And even if a carrier tends to either get bought out or merge with another, policies are still contracts that they're obligated to fulfill. Now, taking the step back to what you were talking about, in the sense of, I could put my money into a money market account, get a higher rate of return. Why put some money into this? The big thing that people need to consider about long-term care insurance is that you're putting the responsibility of getting this care on the insurance carrier. If you didn't have a long-term care policy in place and you were going to self-insure, you had the funds to do that, that is a wonderful situation for someone to be in. But when that does happen, you're still going to need to be relying on someone to fulfill the need of going out, finding care, writing checks. Remember, we're trying to provide coverage to someone who is unable to do the normal responsibilities and daily functions of life.
Yeah.
At that point, is that person going to be able to make the phone calls to get the care that they need, to write the checks that they need to pay for it? What long-term care is not just providing monetary relief, but it's also putting it on the carrier to, write the checks to the carriers, or to the coverage that's needed, the care. It's all falling on someone else, because if you don't have the carrier doing it, someone else is going to have to be. So you're putting
Right.
the responsibility on someone.
And to your point too, yes, these are policies that do cost a little bit more upfront, but if you think about the trajectory of a regular long-term care policy and those costs, right? We can see how they continue to increase. And so when we think about long-term care, what is the total cost of the insurance over a lifetime between now with a standard long-term care and when you might use it statistically 80, 82, right? Versus you pay for it more on an annual basis, but only for 10 years. And so, or only as a lump sum or whatever the case is. At some point, those two lines are going to intersect and it will have made sense to do one over the other. And I think that
Absolutely.
that's one interesting way of looking at it too.
Yeah, it's an interesting way of looking at it. It's also the big thing, like we just covered, is when you're looking at the difference between hybrids and traditional long-term care. Yes, one of the biggest parts is the fact that hybrids are more expensive. But remember, you're going to see this money back in one way or another, whether it's through
Right.
the care that's being provided through the policy or through the death benefit. When you're looking at a traditional long-term care policy, along with the fact that there are going to be increases on that premium, you may potentially never see anything in return if you decide to cancel the policy, or if you pass away. These are risks that cannot be avoided when it comes to a traditional long-term care policy. As opposed to a hybrid, you're always going to see that money come back to you one way or another. And that's a big thing, because when it comes to traditional long-term care, and especially the federal program, here's traditional long-term care outside of the program, you will see, in, let's call it, a 20-year span of having the policy, you will see potentially at least 6 price increases
Mm.
during that 20-year period. Look at the federal program. The federal program is doing 4 annual increases over the next 4 years. That's 4 in 4 years' time. Who knows what the future is going to be after that? And the truth is, as time goes on, like you said, the cost effectiveness will actually, you could potentially be spending more money in the traditional plan as opposed to the total cost of a hybrid. Just another tidbit that, to get a bit more insightful of how the process works, where life insurance, you would go through the medical process, maybe needing a medical exam to be completed. The long-term care underwriting usually only consists of a 30-minute phone interview. This is where they're going to be asking questions, every question under the sun, about your health. What your daily activity is like, if you have any missteps in the sense of, achy joints, or, replacements that
Skydiving,
you've had.
making explosive devices,
Exactly.
riding motorcycles.
Right. They're going to be asking everything to really get a picture of what you do on a daily basis, and also what your health is like. Now, from that interview, they may request more information. For instance, gathering medical reports from your doctors, potentially needing a blood exam. But really, that phone interview is the real, I would say, the real most of the process that's required for an individual to have to go through. Outside of that, it's pretty much on the carrier or your advisor to who you're working with to gather up the information that's requested to get an answer. I won't say there's really anything that someone can do to prepare themselves in the sense of if they're an unhealthy individual trying to get something that they probably won't qualify for, there's really nothing someone can do outside of just going through the process to determine if they're approvable or not. What I think is really important, especially for your clients, is have this stuff looked at, have this stuff reviewed, because even if you're in the federal program and let's say you're in your 40s, you're very happy with it, with the potential increases that can occur, you just don't want to wait too long to look and see if there's a better option out there. For instance, with these hybrids, yes, they are expensive. I'm not going to softball that. It is the reality. But if you start a hybrid policy early enough, you really can take advantage of that inflation rider where you're keeping the premiums low or as low as possible and really building up substantial growth in the policy as the years go on. So I recommend, even if you have long-term care in place, look at it as early as possible, because you could be potentially saving yourself tens of thousands of dollars in premium costs if you start a policy, in your late 40s, early 50s.
Well, Ben, this has been super helpful. I know people come to us with long-term care questions. It's part of our retirement planning process, every single one of them. But of course, we understand it from a perspective where you are really the expert in boots on the ground, understanding how these products work, which carriers are doing what, and how to really be thinking about these things. So if people are interested in kind of reaching out to you or your firm with more questions about long-term care, or maybe analyzing what they have currently or don't have, what's the best way? You had mentioned, I think an email is best to contact you, right?
Yes, absolutely. My direct email, I can list it out right now. It's bgreen, the color, so BGREEN at GWELLC.com. You can also get information to contact me on my company's website. That's gwellc.com. I'm also very happy to just go over this type of information to give people insight. I don't look at everybody as, a client or a potential client. I'm really happy to just give information so that people know more than they started before having a conversation with me.
And thanks again for joining us. I know this has been super helpful to us and all the conversations we've had even before here. And I know that the community is really going to benefit from this because there's so much misinformation or so much information to really even be able to sift through. So having this as an available resource to them is going to be super helpful. And we'll put Ben's contact information too in the show notes so that if you guys are looking to reach out, feel free to just send him a note.
Thank you, Tiago. It's been wonderful. I hope this was helpful to people. And like I said, there's a lot more information that comes along with this. I'm happy to talk to anybody to give them that insight.
Sounds good. Thanks, Ben.
Have a good one.
So there you have it, folks. I hope that was helpful to you. Ben has a lot of really great information. And if you're a late career federal employee interested in learning about how we're helping our clients have better retirement plans, then check out our website at thefedcorner.com. Until next time, stay wise and stay wealthy.